Good morning, I'm Yahoo Finance Executive Editor Brian Sozzi, coming to you straight from our newsroom in New York City. It's a darn busy morning for markets, and for me, I'm declaring today Hot Take Thursday. Here's what's up in the investing world. One, so much chatter on X about whether to begin buying crashed out software stocks like Salesforce, Workday, and ServiceNow. Retail investors appear game to catch falling knives. Look at this rabid buying retail investors are doing of software stocks, per a new chart making the rounds from Avanda Research. I say, get real. Why are you trying to be a hero on a software trade that absolutely sucks right now? Let the dust settle before throwing on that cape. One trade that has been hot, consumer staples. So I've been spending the week looking for this trade to be justified by big food. Coke's earnings were pretty solid this week. Kraft Heinz were absolutely terrible. McDonald's U.S. sales blew me away last night like an undercooked Big Mac. And Budweiser CEO told me this morning by video call his Super Bowl ad did the trick with consumers. Bottom line, I'm still not sold on the consumer staples trade, and I think the space is underselling GLP-1 risk. Here's McDonald's CEO Chris Kempczynski said on GLP-1s last night on his earnings call.
We don't yet see evidence of it really having a material impact on our business. We know that consumers' behavior changes. We know that in general, they eat fewer calories in a day, but also what they eat, the mix of that changes.
And in case you're wondering, 590 calories, that's what comes with the Big Mac. Lastly, normally I wouldn't care less about an earnings report from computer player Lenovo. Like really, it's Lenovo. But the company's CEO said today the memory chip shortage hammering hardware companies like his will persist into year-end. Cisco CEO Chuck Robbins echoed the sentiment on his earnings call last night. And all this is great news for one of the hottest stocks in the entire world, memory chip player SanDisk. The stock is ripping again pre-market, in part because of commentary like I just laid out to you from Cisco and a Lenovo. Let's keep these hot takes coming, friends. My man Kenny Polcari is here. He's chief market strategist at Slatestone Wealth. Kenny, always good to see you. Before I ask you like 9 questions on software stocks, tell me about this photo. Let's get up on the screen here of you in our kitchen drinking wine and beer. That's the new Trader Talk. It's like very like moody, set against a backdrop of darkness. I mean, what are you doing?
Listen, I think they did a great job with it because it doesn't even look like I'm sitting in the cafe there, right? It looks like we're out to dinner at a great restaurant, which was perfect. That was a great conversation. It was an initial one with some of these senior guys talking about first lessons of trading in the industry when they first came into it at 20 years old. It was just published yesterday, so viewers can find it on Yahoo Finance.
Kenny, what was in that glass, man?
There was delicious red wine in that glass, by the way. It was great. I'm not sure. I can't see the brand. I didn't pick it. You guys picked it, actually, but it was great red wine.
Well, if we picked it, I'm sure it was a $500 bottle. Kenny, I want to get to I want to get to the, or sure, maybe even $50 bottle, whatever it is. Kenny, I want to get to these software stocks. You heard my open here. I'm not jazzed up about what's happening in this space. Every day, seemingly, these stocks have completely fallen off a cliff. What say you?
I think it's getting to the point where it is, in fact, overdone. And based on that chart that you showed, where retail investors are kind of thinking the same way too, right? They're taking advantage of some of these stocks on sale. Look, we've discussed this before. The AI trade is still very much in its infancy. There's lots of anxiety, what's it going to change, what it's going to delete, what it's going to eliminate. But new jobs will be created. We've seen that in every industrial revolution we've had. While it's uncomfortable at the beginning, it is what it is. But ultimately, it all works its way out. Now, this one may be a little bit more anxious because AI is kind of changing how you and I interact during the day, maybe more so than prior industrial revolutions. But one way or the other, I think you have to stay focused on it. You have to realize kind of where it's going and where it's taking the world, not only these industries. I think stocks at good names that get oversold are where the opportunities are.
Kenny, you're a rational guy. Is Workday going out of business?
Is who?
Workday. Salesforce,
no, I don't think
ServiceNow.
I don't think Workday's going out of business at all. I mean, look, for us, Salesforce is a key component of what we do and how we use it and how it keeps, everything together. So I don't think Workday Salesforce is going out of business at all. Will it change? For sure it's going to change. Everything's going to change, but that's part of the process. But no, do I think it's going out of business? No.
I was thinking back, Kenny, to those days I used to see you down at the New York Stock Exchange floor. On days when we saw these really big moves lower in stocks and markets, would you be out there buying? And I think we could apply that mindset to what we're seeing in the software and that chart we were just showing on retail investors. So they were just not doing much. They were not doing much. And then really recently they've come out there trying to be heroes. And there you can see the chart right there, picking a bottom in software stocks. Would you do that? You were a trader on the floor. Would you go and do something like that?
Yeah. Okay. So there's two things here, right? I was a trader. I was, though, an institutional broker. I was not on the floor trading for myself. I was representing mutual funds and hedge funds and pension plans and big asset managers. So to your point, there were some that absolutely would see an opportunity in names that had gotten beaten up, and you would be a buyer. But like everything, there were others that saw nervousness and anxiety, and clearly they were a seller, because that's what makes the market, both buyers and sellers. But on times like this, when stocks were overdone, most of my clients, which were mostly hedge funds, were always the ones kind of in there on the buy side for sure. I did not represent retail when I was on the floor. It was all institutional, so I can only speak from the institutional point of view. But on the next subject, as we're talking about, is Workday going out of business or is AI going to destroy the world? Look, I was a perfect example of someone that got run over by technology, right? The job I did no longer exists. There's nobody left down there. It's all automation. But then there's new jobs created, new opportunities. So that's why I say I'm more optimistic about it. I think people should be optimistic about it.
Kenny, your aura lives down there at the New York Stock Exchange. Don't undersell yourself. But everything we're seeing with software, shouldn't it make the case, if you hate software, you buy the Mag 7, even though they're investing billions upon billions of dollars in CapEx?
I think 100%. I mean, look at the names we're talking about. NVIDIA. By the way, after TSM's announcement earlier this week or late last week, I forget when it was, NVIDIA, I'm expecting in February, at the end of the month, when NVIDIA reports, I think they're going to report another blowout number, and they're going to talk about what the future looks like. I think it's crazy for people to start bailing on names like NVIDIA or Apple or Amazon. I think it's nuts. So I think when you see an opportunity, I don't say you go out there just buy it haphazardly. You got to be strategic about it. But when they're under pressure and oversold, and the fundamental story for them hasn't changed, that's the opportunity. So I do not think you should be throwing them out, throw the baby out with the bathwater. Absolutely not.
Kenny, I want to start building this thread here because I'm talking to, Art Hogan, talk to my man later on my show. And I think the economy is surprising to the upside. You saw the jobs report yesterday. By and large, corporate earnings season has gone well. Sales are rocking. Earnings are surprising to the upside. What is the trade? What is the play for an economy that is surprising to the upside, which might mean fewer rate cuts?
So what I think it is, and I think it's evident and you can already see it, I think the play this year is going to be much more cyclical, defensive, kind of value names, and it's already playing out. The value trade is up 4.5% so far this year. The growth trade is down 1.5%. I know that, maybe it's early in the year, but I think what you're seeing, look at energy up 22% year to date. Look at consumer staples. I heard what you said about consumer staples. Consumer staples is in third place.
But it's rocking. Staples have been rocking.
It is
Kenny.
rocking, but that's where I think people are going to find the opportunity this year. I think growth is going to be okay, but I think value, to your point, with an economy that is as robust as it is, and we saw that yesterday in the non-farm payroll report. Look, private payrolls yesterday went up 172,000. Take out the loss of government jobs, and that gives you the 130,000 number, which I think is great. A loss of government jobs, I think is perfect. I think that's where you want to be. You want more private payroll to support the economy, and that's what we're getting. And that's why people should be bullish, and that's why they should be optimistic.
Well, what's better? What do you want to see more of, Kenny? Do you want more rate cuts, or do you want a strong economy? Because you can't have both.
I don't want more rate cuts. I'm in the camp that we shouldn't be cutting rates. In fact, I was not a supporter of the last rate cut. Okay, we got it. But I do not think, and I've been very clear about this, I don't think we need. Look at this economy. Look what happened yesterday. There's nothing that screams, oh my God, we're going down the drain. Not at all. So I actually think rates are fine where they are. I don't think they should stimulate. Now, if Kevin Warsh wants to cut rates, he better also start shrinking the balance sheet. You can't cut rates and not shrink the balance sheet. So if you shrink the balance sheet, which becomes restrictive, but cut rates, which becomes stimulative, then you kind of balance it out, and that would be okay. But barring that, you can't just go ahead and cut rates like as if the economy is screaming for it. It is not.
Kenny, you are my man. You always make time for me, but I am a little upset with you. You didn't invite me to that Trader Talk episode. I can use some wine. I would have brought some whiskey.
Listen, dude, they're coming up. I'm coming back Monday the 23rd. We're doing it again. So if you're around and you want to participate, I would love to have you.
Duly noted, my friend. Kenny, you the man. I'll talk to you soon. I'll see you in our kitchen. All right, I'm cooking with gas today, so let's keep these hot takes coming. Next up, one on Bitcoin. What's bothering me on Bitcoin at the moment is that I don't see the next big positive catalyst. The Clarity Act, when I ask people about that, they almost fall asleep talking about it. If you're watching this and know the next Bitcoin catalyst, hit me up on X, Brian Sozzi. I want to know. I want to know right now. Best answers get a signed Yahoo mug from me. Here's how Robinhood's new CFO, Shiv Verma, told me he is thinking about crypto.
We think there's a huge opportunity to tokenize real-world assets, and that's a great use of the technology. The Clarity Act would be great. Anything else from the regulators, we just want to be able to build in a regulated environment for our customers. So I think there's a lot of catalysts both on the regulatory front, but more importantly on the product side as well. But I think big picture, when you talk to institutional investors, they believe this is on par with the equity markets or any other asset class, and they continue to stay engaged.
I didn't tell Shiv this, but I really like this pull-up, and I need to know who makes it. Robinhood shares, of course, have been hammered this year because of the Bitcoin bearishness, and this is where I find my colleague Julie Hyman stationed at the Bitcoin Investor Week conference in New York City, surrounded by Bitcoin bulls, Julie.
Yeah, I think that's this is their natural habitat, Saz. So I'm sure I'm going to hear some optimism today, even if it's maybe a little bit of a harder time to be optimistic. Even if we're talking about tokenization of real world assets, and institutionalization of the assets as well, maybe those institutions are staying engaged, but maybe they're staying engaged by selling, or maybe just hanging back and holding and watching to see what happens rather than re-engaging by buying in this market. Standard Chartered just out this morning, by the way, cutting its year-end target to 100,000 from 150,000. It's the second time it's cut this in 3 months, and they say we could see 50,000 before that kind of recovery. And that's what I'm seeing in a lot of analysis here, that perhaps Bitcoin prices have not seen the bottom, that maybe they could bounce along here for a while, and then maybe post-summer see some kind of recovery, Saz.
Julie, can you ask every single person that you were talking to? I imagine you're talking to like 800 people. Can you ask all 800 people what is the next positive catalyst for crypto?
I'd be happy to, Saz. I mean, and I'm sure some of them are going to say the Clarity Act. When I talked to Andy Baer from CoinDesk recently, he said that, and I kind of had the same reaction you did. And he said, well, the thing is that the market has sort of priced out the chance of clarity happening in the short term. The likelihood has fallen so low that if it does happen, it could potentially be an upside surprise. So that was one person I talked to recently, and that was his answer to that question. I don't know what other people are going to say, but here are some of the people I'm going to ask that question, Saz. You ready? Anthony Pompliano, this is effectively his event here, this Bitcoin Investor Week of ProCap Financial, well-known Bitcoin advocate and investor. Lynn Alden, I'll be speaking to in the 10 a.m. hour, as well as Matt Hogan from Bitwise. I'll also talk to Scott Melker, the host of the Wolf of All Streets podcast. He's a well-known voice in the industry. He's actually sitting across me right now talking to folks as well. Maybe he's asking them that catalyst question too. By the way, later on today in the afternoon, I'm going to talk to Robbie Mitchnick. He is the manager of the biggest Bitcoin ETF. Of course, he's over at BlackRock. He's the global head of digital assets there. IBIT is that ETF that has gotten so much interest, Saz.
Julie, do you see any gold Bugattis or Lamborghinis parked out front? I know the crypto crowd loves its cars.
I think that's another era. I don't know. I don't know if they're going to be here.
All right, Julie, looking forward to all of your coverage. It's going to be absolutely mind-blowing. Thanks so much. Coming up on Morning Brief, we bring you today's top trending tickers as we count down to the opening bell. And now you find me in the studio. As I've been saying all morning long, it's a busy day for markets, and it has been a busy day for yours truly. I caught up with AB InBev CEO Michel Doukeris earlier today to get the vibe on the quarter and outlook he just served up to investors. There was a lot to like in this company's earnings report. Sales rose 2.5%. Earnings increased by 7.5%. I liked that 2026 operating profit guidance was pinned at 4% to 8% growth. That is solid potential growth for a business like AB InBev, selling commoditized product in beer. I didn't like that volume in the fourth quarter fell 1.5%, but I think the market expects that from beer players at this point. Consumers are choosing healthier lifestyles, and in some cases, beer is a luxury for a low-income consumer battling affordability. Here are three catalysts I do see for this company. One, sporting events such as the FIFA World Cup is this year. Michelle tells me the company typically sees a volume lift around a big sporting event like this. He added the company is seeing strong demand for its Corona beer at the Winter Olympics in Italy. I found it interesting since it's cold and maybe it's not normal you have a beer in that weather. Nonetheless, number 2. A more rational year for commodities prices. Last year, a lot of tariffs came on the industry, couldn't see where commodities were headed. Things will likely improve this year. And 3, improved perception of the brand after a high-profile stumble a few years ago. I think the company's pro-America Super Bowl ad sat well, and it's a message AB InBev is likely to keep driving home this year. I mean, who doesn't love seeing an iconic bald eagle flying off the back of an iconic Budweiser Clydesdale horse? If you don't love it, there's something wrong with you. All right, McDonald's is out with some plump U.S. sales despite the rise of GLP-1 weight loss drugs. The credit goes to the returning McValue menu options. Love that menu. Yahoo Finance senior reporter Brooke DiPalma spoke to McDonald's CFO Ian Borden about the quarter and outlook.
Value really played a key component of the fourth quarter results. Break down how value played a part and also how it brought back in low-income consumers who were pulling back a bit in 2025.
Yeah, sure. Well, I think firstly, I just start with, I think the kind of key, what was key to the quarter? I think there were probably 3 things. One is that you saw that we had holistic strength across each of our 3 operating segments. We had guest count growth globally and within our U.S. business. And we talk about the fact that we've made, I think, significant progress on our value and affordability platforms and how those are resonating with consumers. And it's a challenging environment out there for the industry. And what was really important to us in the quarter was kind of delivering on what we call going 3 for 3, which is great value and affordability, exciting food news for our consumers, and combining that with really powerful marketing or brand activation. And we got all those three things to come together in the quarter. And I think the strength of our results speak for themselves.
Ian, something that we saw the results of was the impact of those extra value meals. Now, that was about a 15% discount on combo meals, but the company's support for franchisees did roll off. One, do you expect franchisees to continue extra value meals? And was that 15% discount enough to get consumers back in the door?
Well, I think extra value meals that we reintroduced in September in our U.S. business really speak to how we're listening to consumers and remaining agile, because I think it was consumers that said, you guys are doing a great job with your McValue platform, but we're still looking for more value and affordability across your core menu. And we put the extra value meals back in place, and we did that with about 98% support in our U.S. business from our owner operators. We are providing support through the end of Q1 this year, so the support hasn't completely rolled off yet. It is more tapered support. But if you go back to when we put that extra value meal program back in place, there were a couple of key metrics that we felt were going to be kind of definitional to success. One was that we were continuing to grow our share with lower income consumers. We did that in Q4. One was that we were going to improve our value and affordability scores. We've delivered on that. And we are exactly in line as what we talked about earlier in our call in terms of where we expected to be in getting the incremental uplift on selling more EVMs to consumers. And so we feel like we have invested to kind of deliver against the consumer need. And that is kind of fundamental in the environment that we're operating in today.
Ian, to double down on that, consumers or analysts, everyone was really taken off guard when you said that a few years ago that McDonald's had lost its value leadership. Do you think that McDonald's has it back?
I think, as you've heard us say several times, we're not going to get beaten on value. We're not going to not win on value. And we have the size and scale and financial strength as a system to kind of invest where we need to do that. And the reintroduction of extra value meals, how we work through that with our franchisees, how we've co-invested to bring that to life, and the results that we've delivered in Q4. And you combine that with the fact that if you look at our average annual owner-operator cash flow in our U.S. business, it actually was up in 25 versus 24, shows that we can make those investments, meet the needs of consumers, and deliver strong top line and bottom line growth.
Now, another thing that Wall Street is really focused on are these tax returns coming soon. They expect 2026 tax refunds to be larger. How would that impact McDonald's? And is that something that you expect as well, especially for your core consumer?
Yeah, I think anything that is supportive to consumers by putting more money, obviously, into their pockets is going to help anyone like us who's in an industry that requires on consumers feeling like they have the the affordability and ability to kind of get into our restaurants and transact with us. I think what I would say is we certainly expect conditions as we kind of look forward into 26 to remain challenging, but we're not focused on the external environment. We're focused on really kind of continuing to execute what's within our control. And we believe if we kind of continue delivering on that 3 for 3, as we talk about, we're going to continue to be able to deliver strong results, irregardless of the environment. And if there's an upside because consumers have more money through things like some of the stimulus that's going in place, we certainly believe we're really going to benefit disproportionately from kind of the upside that may happen there.
Are you seeing growth across all income cohorts, or are you sort of seeing this K-shaped economy that we're seeing elsewhere?
We've talked pretty consistently, certainly in our industry, lower income consumers remain pressured. And I think that has been pretty consistent through the course of 25. I'd say middle income consumers are seeing some pressure, but to a much lesser extent. And then you've got the higher income consumer that continues to kind of be very, very robust. Our role is to make sure we're delivering for all consumers. That's why value and affordability is important, because obviously that's going to resonate with some consumers. But it's when you get that 3 for 3 right, you're kind of meeting the needs of all the consumers, and we want to win in every kind of consumer cohort. So I think that's certainly what we're focused on.
Ian, something else on top of investors' minds these days is the impact of GLP-1s. Now, Citi said that McDonald's is at a moderate risk level to the impact of these drugs. How should investors be thinking about the impact? And could we see something like Chipotle launched, maybe a smaller nuggets package?
Well, I think, you heard us talk a little bit about this in the call, but I think GLP-1 usage, if you look broadly in the US at kind of the addressable population's at about 12%. And I think we certainly expect that trend is likely going to continue to increase as it becomes more affordable, as it becomes more accessible to more consumers. And we're very attentive to that. And I think we are very kind of build that into kind of how we think forward to the business. We've been in business for 70 years by making sure we anticipate the needs of our customers and we lean into those opportunities and continue to evolve. And, the category structure that we put in place earlier in 2025 is really allowing us to get closer and sharper against the 3 key categories in our business, which are beef, chicken, and beverages. We have a lot of protein forward options on our menu today across all day parts of our business. We have options like McNuggets or snack wraps, or in the morning, sausage and egg McMuffin that cater to people that are looking for kind of smaller consumables. So I think there's a lot of choice and variety. And I think obviously what we're going to do is continue to lean in, understand how consumer needs evolve, and make sure we are proactive in kind of getting in front and addressing those.
One thing that you mentioned as one of your key platforms there is beef. You guys are heavily investing in it because, believe it or not, you said on the call that chicken actually is double that of beef. Big Arch is something you guys are innovating with. You also have the Best Burger has been rolling out at a time where beef costs are just exponentially high and still at record levels. How do you sort of offset that with continuing to innovate around beef?
Well, I think, that's the beauty of the fact that we have so much choice and variety across the menu, and the fact that we have these category structures now in place is we can innovate and look at the white spaces in beef, chicken, and beverages. Beef is core to who we are as a brand and business, and so we're going to continue to evolve our menu, understand how we can continue to meet the needs of consumers there. The Big Arch is a great example of that because it was designed to meet that kind of satiating, larger burger format and do it in a way that is uniquely connected to kind of our DNA as a brand. But chicken is a huge opportunity area because, as we talked about, as you referenced, it's twice the size of beef. We have significantly lower share in chicken, and we think we've got a huge opportunity to kind of grow to meet the needs of consumers. And then, as you heard us speak about earlier, we had a really successful beverage test in the US. We had a very positive reaction from consumers when you look at that lineup, which had cold coffees, energy drinks, refreshers, crafted sodas. That resonated really well. It kind of drew us into a different consumer cohort, different parts of the day in our business, and we're really excited about the launch in our U.S. business later this year.
McDonald's with the protein-forward menu items like the sausage, egg McMuffin. I'll be right back on Opening Bid. Go Recaffeinate.